Hi everyone, welcome to today's video. So let me start today's video by sharing a very important anecdote with you. So a few months back, I invested in a company called as Wint Wealth. And over the last few months, the company has been doing exceptionally well. So my investment in the company has also manifolded. Now more prominent investors are joining the company. The founding team has been great. The product is finding the product market fit and getting excellent traction in the market. So it is very likely that over the next coming few months, my investment in the company will 10x. Now I'm not telling you the story from the point of view of boasting that, hey, see how great investment I have made. No, nothing like that. I'm simply trying to tell you the fact that when I started my career, I used to be an extremely risk-averse person. For example, when I got my first paycheck, my idea was that go invest only in fixed deposits or go invest at max in mutual funds. And that is what I did. And I kept suffering for returns for 2 years in my life. Similarly, when I started my career, my objective was very risk-averse. For example, go get an MBA from a top-tier institution, get a good job, and then keep working in that job. Don't even try any new things. And retire at some stage. Now, I'm not trying to say that corporate jobs are bad. No, absolutely not. Corporate jobs are wonderful. I myself praise corporate jobs. I have learned a lot from corporate jobs. But there was a specific mindset with which I approached any endeavor that I took in life. And that mindset was that minimize risk at all cost. That is simply what I wanted to do in life. Don't take any risks and that's it. Now, that's a very bad thought process simply because of the fact that when you are on the younger side, you should be taking risks. Why? Because if you make some bold moves, that can really redefine your life. And that is the perspective with which I'm shooting this video. And this is one of the most important videos I'll be doing on this channel. I wish that someone at the start of my career would have told me these 5 key points that I'm going to talk about with you today about risk taking. That would have transformed my life quite a lot. But I've learned these points through trial and error and I'm sharing this with all of you. So please give it a thumbs up in case you like the content. So let's get these 5 points started and let me first and foremost talk about the BCG's matrix of taking risk. Now this framework has not been given by BCG. BCG has given something called as BCG 2x2. So I'm just contextualizing this framework from a risk taking point of view. So let me first and foremost help you understand some of the key terms. Now risk reward simply can be understood by using an example. So let's say that you're risking 100 rupees. Then the reward is that you will be making 150 rupees, that if you win that bet. So the risk reward equation here is positive. So this in simple terms is called as risk reward equation being positive, that for taking certain unit of risk, you are getting higher certain rewards. Now, what is sensible and insensible risks? Now, that is also a very important point. So insensible risk simply means, for example, let's say that you are very passionate about entrepreneurship. You quit your job and you start your business and the business fails. And then you are back in the job market searching for a job. Now, that might be an insensible move if you don't have your ducks in a row. So what is the meaning of ducks in a row? So that is the phrase for today. So let me know in the comment box what ducks in a row means. So the bottom line is that don't take risks on things that you can't afford to lose. It is okay. It is completely okay to quit your job, start a side business or start a business, jump full time into it if you have a fallback plan. If there is no fallback plan, you don't have things sorted out, then it might be a bad move to take such a risk. Now, one simple strategy to figure out whether something is a sensible risk versus not is to use this acronym. It simply means best alternate to not winning. Now, in case you have taken a risk and if that risk does not pan out, then what is your plan B? That becomes your best alternate to not winning. So if you have an alternate in hand that in case you are leaving your job and your venture is not succeeding, then you still have an option of going back to the job market because your old firm will take you back. That could be your plan B. Or you have a friend whose startup you could join, or you can have a family business that you can fall back onto. So these are all your plan Bs. As long as you have a plan B, you are making a sensible move. So this is how I define risk taking. So essentially any risk that you're taking in life, the risk reward equation should be positive. And number 2, you should have some kind of plan B going. Please avoid taking insensible risk, especially at the start of your career, because it can be disastrous for your career. Now, yes, sometimes it can happen that the risk reward equation is very high. For example, if you are investing 100 rupees in something and the potential is that 100 rupee can become 10,000 rupee. Now, it's not as if that here you should go and invest all your money in it. But if you are relatively wealthy, then it's okay to put a lot of money in that scheme. That will be okay. So the bottom line is that at the start of your career, you should not be taking insensible risks. For example, if someone tells you that go and invest in XYZ asset. It will give you 1000% return and invest all your money in it. No, please don't do that. That is just disastrous. Please never do such a thing because you will not be able to get back to investing. That will qualify as insensible risk. On the flip side, let's say that you have identified a really good stock, it's a penny stock or it's a small cap stock, and you are okay investing a little bit of money. It's completely fine because even if you do not win in that bet, you can still come back to the stock market. But never take risks in life where the risk reward equation is negative. For example, you are taking 150 units of risk only to make 100 rupees of return. That is just senseless. Please do not do that. And number two, please do not take insensible risks in life. That is just really, really bad. I'm harping upon on this point, but I get a lot of messages from college students saying that Akshat, I want to become like a full-time trader. Should I drop out of college and become a full-time trader? Please don't do that. That is just insensible risk taking because you are killing your earning potential very early in life. If you fail at becoming a trader, what is it that you are going to do next? You will have very limited options then. So please remember these two critical points from this discussion. Now, how do I apply this framework in my own life? So very quickly explaining it. So for example, I invest quite a lot in cryptocurrencies. I invest in startups. For example, Wint Wealth is one of the startups in which I have invested. Have I invested all my Jama Punji in startups and cryptocurrencies? The answer is no. I would have approximately 20% of my portfolio in these things. Subsequently, I'll go for opportunities where the risk reward equation is slightly lower on the risk side. For example, when I'm investing in FMCG stocks or when I'm investing in sensible large cap companies, the risk goes even lower. So that is how I'm designing my portfolio, and all the risk that I'm taking is sensible risk. Now, the second critical point about risk taking that you must understand is that risk taking comes with practice. Now, here is a very interesting exercise for you, and tell me in the comment box why this is the case. So this was a study that was done by Reserve Bank of India, and this research tells us that approximately 95% of average household wealth in India is tied into either real estate or gold. Now, if you take a look at the last 10 years return of real estate, it has been roughly 10%. If you take the average CAGR of gold returns, it is roughly 5.7%. So both these asset classes have given really poor returns, but majority of Indians are tying their wealth into these asset classes. Why? Let me know in the comment box. The answer simply is, and majority of us feel that if we are holding on to real estate or if we are holding on to gold, then these are somewhat risk-free assets. The answer is no. These are wealth preservation assets, yes, that your wealth might not go down, but these are definitely not investment grade assets, so to say, because of the returns that they have been giving for the last 1 decade. And this is not made up fact from my side. This is all research and data that tells us this. Now, the important point that I want to tell you from this discussion is that we are always conditioned. If you have grown up in the middle class like me, you will categorically understand we are subconsciously wired to take less risk. For example, fascination with government job. Why again do you think that we are fascinated with government jobs? Because of the safety factor. So the important point that you need to keep in mind is that risk-taking abilities are cultivated over time. It's not as if that one day you will suddenly wake up and suddenly you will have that foresight and insight to start taking risks in life and you will drop everything and become an entrepreneur. That type of personality change will not happen over time, but you must understand that there will be a natural progression towards you becoming a more effective risk taker in life. What you can do in terms of improving your risk-taking appetite is that you can start experimenting with 10% of your time and 10% of your money. That is a rule I give it. I call it the 10% rule. If, for example, you are investing in the stock market and you have a portfolio of 1 lakh rupees. So take out 10,000 rupee and start looking for slightly more risky investments. Now, this is not an investment advice. Please do it at your own risk, but I'm just telling you a method to become a more intelligent risk taker. You will learn risk taking by actually doing stuff. Same goes for starting something new. So rather than leaving your job and starting something new, try experimenting with 10% of your time. So you are working, let's say 10 hours a day, right? Now, instead of working 10 hours a day, work for 9 hours a day on your primary job and take out 1 hour where you can start building your side gig. So that again becomes like a 10% rule that you are dedicating 10% of your effort, time, energy, and money to learning how to take risks. And the only way to do is by actually taking these bets. Now comes the third point that you must understand the concept of asymmetric risks. Now, what are asymmetric risks? Now, asymmetric risks simply means that you are taking very few high-powered risks that can give you very high returns. So let me explain this point by taking you through my own journey of quitting management consulting. Now, when I told my parents that, hey, I'm going to quit management consulting, they were, of course, taken aback. You are making such good salary. Why do you want to quit your job? Have you lost it? The answer was no, that I have not lost it. I have a specific plan in place. So it's not as if that my parents were not supportive. They were super supportive, but initially that shock was there that, hey, that why are you leaving such a well-paying job to do something of your own? It did not make much sense to them at the start. But this was an asymmetric risk in my life that at one stage in my life, I wanted to quit my corporate job and start something of my own. And I had a very specific plan around it. I had already been experimenting with that idea for close to a year. I had some paying clients already. So from that particular perspective, I was able to walk them through a plan and take this asymmetric risk in life. But the important point that I want to leave you with is that taking these asymmetric risk is not a flash decision that you can just wake up one morning and decide that, you know what, enough of this, I'm just quitting. That will be bad. That might turn out to be really, really bad and ugly for you in case you're not prepared to deal with the challenges. A more thoughtful approach is that you experiment with your asymmetric risk first. For example, if you want to start a company, then experiment with it with a close set of people. Try to find your initial customers. When you feel that the idea is getting a little bit of product market fit, then move on to quitting your job. Just quitting everything abruptly and taking risks might not be the most intelligent move. Fourth key point about risk taking is that whenever you are taking and experimenting with things, you are going to fail and you are going to learn from your mistakes. What is the example that I can tell you? So yes, over the last few months, I had been extremely bullish about the EV space and I myself have invested my money in several EV stocks. Now, have I put all my money into EV stocks? No, I have never done that and I never advocate doing that. But over time, as I've read more and more and with recent developments in the EV space, it's not as if that I'm not bullish about the EV space anymore. This EV narrative right now might take some time to get baked completely. So there is a lot of churn that is happening in the market. So if I can go back in time and wait it out, would I do it? Yes, I would wait a little bit and then I will take positions in different EV stocks. But this is a mistake that I made. I learned from it and I refined my risk-taking style accordingly. Now, this is not a recommendation for all of you to cut your EV stocks. Even I am not cutting my EV stock. I'm just simply trying to say that I was a little bit early in the EV game. I should have probably waited a little bit before taking more positions. And that is precisely what I'm doing. I have not maxed out all my EV positions on stocks and subsequently I will take more positions in it. But important point is that whatever risks that you are taking, sometimes you will get a lot of learnings from it. Pick those learnings up and be mindful from the next time. Now comes the fifth and final point that whenever you are taking risks in your life, always remember the first principles approach. Now, what is the first principles approach? I have made a separate video on this. You can go and check it out here. But in simple terms, first principles approach tells us that you must reduce any complex situation to its absolute bare minimum. Now, just to explain you a little bit as to why did I choose to invest in Wint Wealth, the answer there was fairly simple. That Wint Wealth, what it simply does is that it positions itself as launching bond-related products, which gives you higher returns than fixed deposits, but are not as volatile as equity markets. Now, there will always be people who would be interested in investing in such products. Why? Because people don't want to take risks that are associated with the stock market, and they definitely want to make more returns than the fixed deposit. So from that perspective, there was very clear product market fit for something like Wint Wealth. So therefore, I invested in that. It's not as if I'm advocating about Wint Wealth now because I'm an investor, but it was the other way around. That I became an investor because it was a good product which I could think from a first principles perspective. So whenever you have a decision to make, for example, a lot of people debate that, hey, should I be investing in crypto market or not? Again, just boil down your decision to first principles. For example, ask yourself that, hey, if I invest 100 rupees in the crypto market and if the crypto market survives for 10 years, how much money am I going to make? Probably that 100 will easily turn into 1000. And what is the maximum loss that you can take? You will probably lose 100 rupees. So from that particular perspective, ask yourself, is that risk reward equation sensible or not for you? Now again, not an investment advice. I'm simply trying to tell you how to think about risk taking. So just in summary, 5 key points. One is that we analyze the BCG matrix, that how do you take insensible versus sensible risk and how do you ascertain the risk reward equation for any risk that you are taking. Second key point, there is a natural progression. Risk taking abilities comes with taking more and more risk with time. So for this, what you should do is that you should allocate 10% of your time and 10% of your money in terms of learning about risk taking. Number 3, all of us should take some asymmetric risks in life, but we should be very, very thoughtful and careful with these big moves in life. For example, in my case, that asymmetric move right now for me is investing in startups. Fourth, we will all make mistakes in this journey of risk taking. So every time you make a mistake, please learn from it and refine your risk taking style and abilities. Fifth and finally, always use the approach of first principles. Break down a complex argument into really simple thought process that will allow you to make a go or no go decision on risk taking. I hope you enjoyed the video. Please give it a thumbs up and I'll see you tomorrow.